Welcome to the Note Nuggets podcast, where you can learn how to become the bank, build wealth, and accumulate streams of income perfect for your savings or IRAs. You'll hear from industry experts, seasoned veterans, and everyday investors. Our goal is to teach you how to invest in notes, one nugget of knowledge at a time. Here's your host, Kevin Galang.
Welcome to another episode of the Note Nuggets podcast, where you can learn how to turn others' debt into income that's perfect for your savings or IRA. When it comes to note investing, there are performers and non-performers. The difference between them is that a performing note is when the borrower is paying, and the non-performing note is when the borrower is not paying. Other than that main distinction, there are more things in common between the two types of notes than there are differences. For example, both notes are protected by a mortgage. Both notes have equity built into them if you buy right, which generally speaking, you're going to buy both at a discount. Both notes don't have to worry about maintenance. There's no leaky roofs, there's no termites, there's no tenants. You are the bank, and that's the beauty of note investing. And there's one more important common ground between the two types of notes, and that is the borrower and their ability to pay back that mortgage. With the performing note, there's always a chance it could go non-performing. So you need to do your due diligence to make sure that they can, in fact, make their payment. With a non-performing note, the borrower's ability to pay is huge because it can indicate what type of an exit you can take as the lender. To tell us about how mortgage companies assess borrowers, I brought on a residential mortgage expert to share how lenders assess borrowers. First, let's get to know our guest. Mike Sirocco is division manager for one of the most profitable divisions of Nations Lending, a residential mortgage company where he assists home buyers finance the purchase of their dream homes. When he's not helping people with their dream homes, he's passionate about helping people through his public speaking, performance coaching, books, and What Are You Made Of podcast. Okay, and when you were talking about the due diligence on the borrower, can you clearly lay out exactly what you're, as an industry professional, what you guys do to say this borrower is good enough for us to lend to, what you look at, those factors?
Yep. So we look at credit score, right? We can lend down to 580 on government loans and 620 on conventional loans. So we look at credit score. We also look at the ability to repay, and that's measured based on the debt to income ratio. We look at that based on all of their debt compared to their income and their mortgage payment compared to their income. There's two different ratios we look at, and we keep it below threshold. There's also the history of their payments and their credit and judgments and deferments and forbearance, especially with COVID. People went into forbearance a lot on the mortgages. We look at that and make sure they're back on track. And we also look at the amount of money they have in the bank, the number of reserve months they have available to them in case something happens. Not all products require monthly reserves, but it's something that we do look at. And those are the basics of it. The loan to value is not necessarily something we qualify people off of. That would filter into a certain product range or needing mortgage insurance, but you can't qualify a borrower off a loan to value anymore. So those are the things that we primarily look at when we're underwriting a file.
Nice. Okay, that helps me understand that. And I think as an investor, people that are listening to this, if the lending companies are looking at a borrower's ability to repay and you see red flags in that as an investor, keep that in mind, right? They may be performing for the last year, but as you talked about, the economy is shifting. If they have too much debt, that might be a big sign. So that's something to be aware of. And that's how a national lending company assesses a borrower before they decide to loan the money to them to purchase their dream home. To gain full access to my interview with Mike Sirocco and learn more about mortgages from the professional lender's perspective, head over to notennuggets.com/borrower. Thanks, everybody.
Thank you for tuning in to this week's episode of the Note Nuggets podcast. Be sure to subscribe to the show to get access to additional weekly value nuggets and get notified with episode updates. To subscribe, all you have to do is head over to subscribe.notenuggets.com. If you have any questions about this episode or note investing, book a time on Kevin's calendar at contact.notenuggets.com. We'll see you next week with another note nugget to add to your tool belt.